Welcome to my investment portfolio channel, where I'm going to be taking a look at my top winners and my top losers this week, talking about what type of news caused them to move in the direction that they did. I'll also quickly go over my pies that I've split my portfolio into and see if they're performing like I expect them to. In today's video, I also want to touch on a stock that seems to be leaving everyone's mouths this week in NIO. So enough talking, let's go over to my pies. It's been a long time, but my pies are now all in the green, and that was mostly helped by the so-called rotation out of stay-at-home stocks that was seen especially at the start of this week. Now, I don't really like that term stay-at-home stocks because a lot of them are admittedly tech stocks, and yes, their performance was accelerated by the whole COVID situation, but a lot of those stocks perform well under any circumstance. So I think once the euphoria kind of dies down of this new vaccine that is still months away from being readily available, the stocks will come back up strongly. Last week I mentioned I was getting rid of Cisco, but after their good earnings call, I may just have to, pause on that decision. It was something under review, so it wasn't penned in that I was going to sell it anyway. But I did sell my position in my gold ETF as it was in the green, with the intention of investing in that new Bitcoin ETF that I talked about in my previous video when the short-term price is right. My other pie in my investment account, that's doing well, as you can probably expect when holding these Chinese stocks. And those are the current statuses of my pies, so let's get into my top winners for this week. Starting off with Celsius Holdings, which finished 37% higher this week, and seeing this just makes me even more eager to reduce the holdings in my portfolio, because I could have invested more into this if I wasn't diversified so much. But anyways, Celsius Holdings recorded record revenues during their recent Q3 earnings call. Analysts expected growth, but their expectations were blown past as earnings were 80% up year over year, which was helped by their increased distribution. They also reported profits that were more than double that of last year. Net income slipped a bit, but this was due to amortization expenses. So all in all, these are good signs. It's also interesting because a lot of their sales came from gyms and fitness centers, and of course due to COVID, one would have expected that to slow down, but it didn't, and I guess that really shows the loyal consumer brand that they have built. They also mentioned that they're debt free, which is an added bonus for this company. Legal in general are up a surprising 23% this week, and I think as mentioned before, this was boosted by the vaccination news. I also read that it expects operating profits for this year to broadly fall in line with that of last year's, and that it's planning to keep its dividend flat. Given what the world has gone through this year, I'm not overly mad about that. They set out an ambition to grow their dividend by low to middle single digits from 2021, which is slower than analysts hoped for, but I think overall, Legal in general, in my eyes anyway, have handled business fairly well during this whole difficult period. Starting off with my top losers this week, we have BYND Meat, who had an absolute stinker of an earnings call and is down 20% this week. BYND Meat reported a surprise loss of $19 million for its third quarter, with net sales increasing only 2.7% versus the year ago period. The company said the poor performance was the result of impacts from the pandemic that it hadn't yet felt in previous quarters. This included a reduction of people stockpiling items like they were doing at the beginning. There was also news that McDonald's were experimenting a new plant-based burger, McPlant, which sent shares lower for BYND Meat because it meant more competition. But then news came out that they actually might be involved in this whole McPlant business, so that caused a bit of confusion. BYND Meat also partnered with Pizza Hut to start rolling out plant-based pizzas, which will of course get them more recognition. So a mix of good and bad news, but I think more bad news than good, and I wouldn't be surprised if investors looked at the price of BYND Meat and started to take some profits here due to the growth it's experienced over the last year or so. Next up, we have Alibaba, that obviously suffered at the hands of bad news last week around the postponement of Ant Group IPO. And this week, they've fallen due to regulatory initiatives from the Chinese government that were announced for big tech companies on Tuesday. I don't think we actually know all the factual details of the postponement of Ant Group's IPO, but maybe that was just a glimpse of the new measures to be taking place to limit the amount of power these big tech companies have. I mean, Alibaba controls over 50% of the country's e-commerce market and has about 33% stake in Ant Group, so they are an overpowered company if I do say so myself. So we could see some more volatility trading in the near terms as we continue to get more information about these regulations. At the moment, as it continues to drop, I'll continue to buy, but if anything significant comes out of the regulations, then I might just have to review this company again. That was a quick look at my portfolio this week, and let's just get right into talking about NIO. I'm pretty sure everyone is aware of the phenomenal gains they've been experiencing, helped by the rising tide in the Chinese EV market, as well as China's ability to handle the pandemic better than most countries, so I don't need to get into that. But recently, a short selling firm, Citron, and I'll emphasize again, a short selling firm, has recommended investors to sell stock, as well as given a price target of $25. This comes 2 years after being bullish on them when they were trading at $7. They begin the document by saying, NIO has found itself in uncharted territory that can never be justified by its current standing in the China EV market or its near-term prospects. And at that point, I kind of knew that, this was just a short-term fear-mongering trading tactic, right? Because in the long term, which is the timeline a lot of NIO investors have, I can almost guarantee that NIO's price can easily be justified. It then goes on to say that NIO's ES6 faces imminent threat from likely price cuts for Tesla's Model Y in China. According to their note, anyone buying NIO now is not buying a company, you're buying 3 letters that move on a screen. Can I just quickly say that Citron's website is clapped? Like, this document is so ugly. The formatting and the way they've used pictures, it just looks unprofessional. You know those little projects that I used to submit in the beginning of secondary school or whatever? It just reminds me of that. It's just so ugly. But let me not digress too much. Now, I understand Citron have been about studying the market for 17 years, which is 17 times more than me, but Citron are just waffling. I mean, I agree to an extent that if you're trading this stock short term, that you are just buying 3 letters on the screen, because the technicals do not signal whatever crazy number was trading out on Friday as a buying opportunity. But for the long term, I mean, we've seen the numbers NIO have been coming out with. Their battery as a service business model, their improved cash flow. Yes, this momentum won't last, and yes, they aren't a perfect company, but there's no such thing as a perfect company, and NIO has so much room to grow. I really should be happy at this report though, because I don't even have a complete share in this company as of yet, and this drop in price offers me a place to buy in. But what Citron are doing and what they've said, it's very dismissible. Even if you go onto their Twitter, they have an abundance of tweets saying how they're shorting companies from the likes of Square to Shopify, and more conveniently even Tesla. Like I said in my previous video when Hindenburg shorted Nikola, I don't know how these shorting firms exist to have so much influence on the market. It baffles me, and it's very convenient that this is happening a couple of days before NIO's earnings. In my opinion, if that wasn't already clear enough, I do think NIO's share price will fall like every other stock in the market, but I know I'm bringing up this phrase again. In the long term, China's EV market will be a major growth story for years to come. And with the likes of very reputable firms being bullish on NIO, like Morgan Stanley, JP Morgan, Deutsche Bank, I think that says more than enough about Citron's report. And I won't be surprised to see them buying up more NIO shares in the future, like they did with Tesla after saying they were going to short them. They are backed by the Chinese government too, which raises a simple question: would the Chinese government really want to see NIO fail? And on that note, I'm just going to wrap up this video there before I start waffling myself, and I'll catch you in the next one in a bit.